Every company we autopsy on this channel died of something. Bad debt, bad leadership, a market that moved faster than the boardroom could. But this one is different. This one didn't just fail. It built an army first. In 1600, a company started in a single room in London with 125 shareholders and a royal piece of paper. No factories, no soldiers, no product really, just permission. 200 years later, that same company commanded a private army of 260,000 men, twice the size of the entire British Army. It minted its own currency. It declared war. It ran its own courts. It governed roughly a fifth of the human race, and it answered, on paper, to a board of directors in a building in London you could walk past today and never notice. This is the East India Company. And before we get into how a trading business turned into the most powerful corporation that has ever existed, you need to understand one thing about how it ended. In 1773, this company collapsed under its own debt. It was insolvent, bankrupt, and the British government did something no government had ever done for a private company before. It bailed it out. To pay for that bailout, the company needed cash. Fast. So it dumped its surplus tea, at a steep discount with the tax baked in, onto its American colonies. The colonists didn't see a discount. They saw a bailed-out monopoly, propped up by a government that wouldn't even let them vote on the tax. So one night in Boston Harbor, they threw 92,000 pounds of that company's tea into the sea. You know it as the Boston Tea Party. What most people never learn is that it wasn't a protest against a government. It was a protest against a corporate bailout, and it cost Britain its American colonies. That's the kind of company we're dissecting today. Welcome to CorpAutopsy. Let's open this one up. Rewind to the end of the 16th century. Spices, pepper, cloves, nutmeg are the most valuable commodity on earth. Not gold, not silk. Spices. A sack of nutmeg could be worth more than the ship that carried it. The Dutch and Portuguese already have a head start on the spice trade, and they are not interested in sharing. London merchants watch the margins their European rivals are pulling and do what any founder does when they see someone else printing money. They pitch a competitor. On December 31st, 1600, Queen Elizabeth I signs a royal charter granting a group of London merchants a monopoly on all English trade east of the Cape of Good Hope. In modern terms, this is a government-issued exclusivity license. No competitor gets a permit. No one else gets to play. This company, officially the Governor and Company of Merchants of London Trading into the East Indies, is structured almost exactly like a startup raising a seed round. Investors buy shares. A small board of directors votes on strategy. Profits and losses get distributed per voyage, not per year, because nobody's sure if there's going to be a next year. And the risk is brutal. The first voyage in 1601 sends 4 ships and over 400 men toward modern-day Indonesia. It is, by any modern standard, an insane risk profile. Months at sea, disease, storms, rival European fleets with cannons. Of the men who sail on these early voyages, a huge percentage simply never come home. But the survivors come back with pepper, and the math works. One successful voyage could return profits of several 100% on the initial investment. This is not a trading company. This is a venture capital fund that occasionally also moves cargo, high failure rate, occasional moonshot return, and just enough of those moonshots to keep new investors lining up. For the first 100 years, this is mostly what the East India Company is, traders. They set up small fortified posts, what they call factories, in Surat, then Madras, then Bombay, then a swampy patch of land along the Hooghly River they name Calcutta. They are tenants, guests. They pay local rulers for permission to trade. That's the founding pitch. A trading license, a few coastal warehouses, and a willingness to bet your life on a pepper shipment. It will not stay that way. By the mid-1700s, the Mughal Empire, once the wealthiest state on earth, is fracturing. Regional governors, called nawabs, are running their provinces like increasingly independent fiefdoms. Bengal, the richest of these provinces, is one of them. The Nawab of Bengal, a young ruler named Siraj-ud-Dowlah, doesn't trust the company. He's watched them fortify their trading post at Calcutta without permission, and he orders them to stop. They don't. So in 1756, he marches on Calcutta and takes it. The company's response is not to send better trade terms, it's to send a mercenary. His name is Robert Clive, a company employee who started as a low-level clerk and worked his way into a military command. And Clive doesn't plan to win the coming battle with better cannons. He plans to win it the way a modern activist investor stages a hostile boardroom coup, by buying the other side before the vote even happens. Clive's people make secret contact with Mir Jafar, the Nawab's own commander-in-chief. The deal is simple. Betray your ruler mid-battle, and we will install you as the new Nawab in his place, a puppet, answerable to the company. On June 23, 1757, at a mango grove near a village called Plassey, the two armies meet. On paper, Siraj's force outnumbers Clive's roughly 10-1. In practice, Mir Jafar's troops, a huge portion of that army, simply don't fight. The Nawab's forces collapse within hours. This is the moment everything changes. The Battle of Plassey is not remembered as a triumph of military genius. It's remembered correctly as the most consequential bribe in corporate history. Clive didn't outfight an empire. He acquired it through an inside deal with a disgruntled executive. Mir Jafar becomes the new Nawab, and in exchange for his new title, he hands the company a gift worth, in today's money, hundreds of millions of dollars, plus the right to trade duty-free across Bengal. The company has just acquired, through bribery and proxy installation, control of one of the richest provinces on the planet. And it didn't cost the British government a single soldier. But the real structural shift comes 8 years later. In 1765, the company is granted something called the Diwani, the legal right to collect tax revenue across Bengal, Bihar, and Odisha on behalf of the Mughal emperor. Strip away the formal language, and here's what that actually is. A private trading company has just been handed the tax collection authority of a sovereign government. Imagine if Amazon was granted the legal right to collect income tax in 3 U.S. states, kept a cut for administrative costs, and the IRS just signed off on it. This is, in modern terms, an involuntary privatization of an entire region's government. The local population didn't vote for this. The local rulers didn't really choose it. A corporation simply became the state, while keeping all the legal deniability of being just a business. And the company's agents, who ran this new tax and trade machine across Bengal, had a habit. They didn't always ask. They took local goods, local cash, local land, under threat of force, dressed up as duties and contributions. The local word for this kind of seizure was Hindi and Hindustani in origin. Lut. By 1788, English glossaries compiled in India were already recording that word as a formal term for plunder. Within decades, as company wars spread from Bengal to China to the Indian Mutiny a century later, loot migrated out of Anglo-Indian slang and into everyday English back home, describing exactly this exact behavior. The English language still uses a word borrowed directly from the victims of this company to describe what was done to them. That's not a coincidence. That's a paper trail. Here's the part of the autopsy report that should make you uncomfortable, because it should. Bengal, before the company's tax regime, was one of the most fertile and food-secure regions in the world. Farmers grew rice. They grew what fed people. Once the company controls the tax base, the incentive structure flips entirely. Cash crops, indigo for dye, and increasingly opium generate far higher export revenue than rice. So company administrators begin pressuring and in many districts effectively forcing farmers to convert food-growing land into cash crop land. In boardroom language, the company optimized its supply chain for the highest margin product in a market where the customers had no alternative supplier and no leverage to push back. In 1769, the rains fail. Drought hits Bengal. Under normal circumstances, a region this fertile could absorb a bad harvest. There would be reserves, and a functioning local government would intervene with grain and tax relief. But the local government, in any practical sense, is the company. And the company's tax collectors do not lower the tax burden during the famine. In several documented cases, they actually increase it to compensate for the fact that fewer people are left to tax. By the time it's over, the Great Bengal Famine of 1770 kills an estimated 10 million people. Some historical estimates put it as high as a third of the entire population of Bengal. It remains one of the deadliest famines recorded in human history. And here is the line in this autopsy that the channel cannot soften. While this was happening, company revenue from the province did not collapse. In the years immediately following the famine, company tax receipts from Bengal actually held steady, and in some readings of the record, increased. Meanwhile, the men running this operation, company officials who returned to England having made personal fortunes through trade monopolies, bribes, and gifts from local rulers, were given a name back home, nabobs, a mocking, almost satirical English term for these newly suspiciously rich returnees. These nabobs used their fortunes to buy English country estates, buy seats in Parliament, and buy respectability. Several of them became members of Parliament. The same political system that was supposed to provide oversight of the company was now partly staffed by the men who had personally profited from it. If you're looking for the moment this autopsy stops being about a trading company that made some bad calls and becomes something closer to a corporation that engineered a famine for margin and faced zero internal consequences, this is it. You'd think controlling the tax revenue of one of the richest regions on Earth would make a company financially untouchable. Instead, the East India Company nearly goes bankrupt. How does a monopoly with sovereign tax powers run out of money? The answer is almost embarrassingly familiar to anyone who has watched a modern company implode. Military campaigns across India were expensive, and the company kept expanding its army and its territorial claims faster than the actual tax revenue could support. Corruption and mismanagement among company officials in India drained funds that should have gone back to London, and the company's directors kept authorizing dividend payouts to shareholders to keep the stock price up, even in years when the underlying business wasn't actually generating enough profit to justify it. By 1772, the company can't pay its bills. It owes the British government over £1 million in customs duties. It is, by any modern definition, insolvent. And here is the moment that earns this company its place in financial history. In 1773, the British Parliament passes the Regulating Act and effectively extends the company a financial bailout, a government loan to keep it solvent, alongside new government oversight of its operations. This is widely regarded as the first true too-big-to-fail bailout of a private corporation by a national government. The logic given at the time will sound eerily familiar. The company was so deeply tied into Britain's trade, tax revenue, and national prestige that letting it collapse was considered too dangerous to the wider economy. Sound familiar? It's the exact same argument used for banks in 2008. But a bailout loan isn't free money. The company now needs revenue, fast, to start paying it back. And it has a massive oversupply problem. Warehouses in London are sitting on millions of pounds of unsold tea that nobody in Britain wants to buy at full price, partly because of high import taxes. The solution: dump the surplus directly into the American colonies at a price that undercuts local merchants, with the tax already built in, denying American colonists any say in a tax that funds a foreign bailout. That's the Tea Act of 1773. That's what gets thrown into Boston Harbor. The Boston Tea Party wasn't a grassroots reaction to tea. It was a reaction to a government using colonial markets to bail out a failing monopoly without the colonists' consent. Within 3 years, this resentment helps ignite the American Revolution. A corporate bailout helped cost Britain its most valuable colonies. And the company's second move to fix its balance sheet is even darker. With its China trade running a steep deficit, Britain wants Chinese tea, but China has little interest in British goods. The company needs something the Chinese market will buy in bulk, no matter the cost. It finds that product in opium, grown under company monopoly across Bengal. By the early 1800s, the company is running what is, in plain modern terms, an industrial-scale narcotics smuggling operation. Opium is illegal in China. The company can't sell it directly without violating Chinese law and its own charter, so it auctions the opium to independent traders in Calcutta, who then smuggle it into China themselves. Plausible deniability, built directly into the supply chain. The profits fund the tea trade. The addiction crisis this creates inside China becomes so severe that the Chinese government attempts to crack down, confiscating and destroying opium stockpiles in 1839. Britain's response is to go to war to protect the trade. The First Opium War. A private company's product line escalates into a state-level military conflict, ending in a treaty that forces China to open its ports and cede Hong Kong. This is the company at its most nakedly transactional. A near-bankrupt monopoly, bailed out by its own government, pivoting into the drug trade to make its numbers work, and dragging two empires into war to protect the revenue stream. By the 1850s, the East India Company is no longer really a company in any normal sense. It governs roughly 250 million people. It runs its own army, its own courts, its own currency, its own civil service. It has effectively become a state wearing a corporate nameplate, which means it has inherited every failure mode of a bloated, unaccountable government, with none of the public accountability. And like a lot of organizations that grow too fast for too long without real oversight, the cracks are everywhere. Indian soldiers serving in the company's own army, called sepoys, make up the overwhelming majority of its military manpower, yet have no real path to senior command, are paid less than their British counterparts, and are increasingly resentful of policies that disregard their religious and cultural practices. The breaking point in 1857 is almost absurdly specific. New rifle cartridges are rumored to be greased with animal fat, offensive to both Hindu and Muslim soldiers' religious beliefs. It's a single operational decision, a procurement choice, made without consulting the workforce it would affect most. It ignites a massive uprising across northern and central India, a rebellion that, depending on which historical lens you use, is described as a mutiny or a war of independence. It is bloody, prolonged, and brutally suppressed by company and British forces, with atrocities committed on both sides. But the political fallout is what matters for this autopsy. The British government looks at what just happened and reaches an unavoidable conclusion. You cannot let a private, profit-driven corporation continue to govern 250 million people. The risk to the British state's own stability is now too high. In 1858, the Government of India Act formally transfers all of the company's governmental powers to the British Crown. This is, functionally, a hostile nationalization. The very same playbook the company once used on local rulers gets used on the company itself. Its territory absorbed, its army dissolved into the British Indian Army, its administrative apparatus folded into what becomes the British Raj. The company technically continues to exist as a corporate shell for over another decade, managing the last of the tea trade and winding down its remaining obligations, but it has no territory, no army, no governing power. It is a company in name only, kept alive on paper purely for administrative convenience. Finally, in 1873, Parliament passes the East India Stock Dividend Redemption Act, taking effect on January 1, 1874, and formally dissolving what remains of the corporate entity. Shareholders are paid out. The company is liquidated. 274 years after 125 merchants signed a royal charter to chase pepper margins, the company that became an empire is formally struck off the books. So what actually killed the East India Company? It wasn't a single bad product or a single bad CEO or a single market crash. It was a structural flaw present from the very first charter. A private, profit-driven entity was allowed to accumulate sovereign power, tax authority, military force, judicial control, with almost no real check on how it used that power as long as the dividends kept flowing. Every disaster in this story is downstream of that one flaw. Plassey isn't a war story. It's a hostile takeover financed with bribes. The Diwani isn't a treaty. It's an involuntary privatization of a government's core function. The Bengal famine isn't a natural disaster. It's a supply chain optimized for margin with no regard for the humans inside it. The 1773 bailout isn't a footnote. It's the prototype for every too-big-to-fail rescue that's followed since. And the opium trade isn't a side hustle. It's a company finding a new revenue stream after its old business model collapsed, regardless of the human cost of that new revenue stream. The East India Company didn't just predate the modern multinational corporation. In a lot of disturbing ways, it's the prototype for it. The first organization to prove that if you give a balance sheet enough power, it will eventually start behaving like a government and not a particularly accountable one. That's the autopsy. Cause of death, unchecked power, optimized entirely for shareholder return. If you want to see how the next corporate giant on this table built its empire and what finally killed it, hit subscribe, and I'll see you in the next autopsy.